Liquidation of a partnership for the accountant requires some journal entries to close the business. Because what is a partnership liquidation? It's when you're going out of business, so you want to wrap up your business. You have to pay your creditors first and then close the permanent accounts to close your books as soon as the partnership ends. Now, partnership change is not a liquidation. So if you recall, partnerships have limited life, which means any change in membership or structure will end the legal entity, the agreement. Admission of a new partner ends an old partnership and it begins a new partnership. Although you don't have to close your doors, you can still be operating your business, but the legal formation does change. And if a partner was to die, the partnership can result in a change of formation or an actual liquidation. So it is a four-step process for the accountant. First, you want to convert all assets to cash, and then allocate any gain or loss from that conversion on the sale of assets to the partners. The liabilities, the creditors must be paid first, and then finally distribute anything that's left to the partners. So just a memory trick. C, convert your assets to cash. A, allocate gain or loss. L, your liabilities must be paid. And then D, distribute the remaining cash. So if you remember CALD, C-A-L-D, this is the proper order of how to close a partnership. So when you're going out of business, your partners, your owners are going to want to pull all their money out of their capital accounts, but you have to wrap up business first, and you have to have the cash available. So any non-cash assets must first be converted to cash, and often they're sold at a loss because of the urgent need for funds. So looking at an example of a partnership, we have assets of $200,700, total liabilities and equity for the same amount. Looking at the assets and the one liability account, it appears at first you can cover your liabilities. But take a look at this a different way. How much cash do you actually have to cover your accounts payable? Most of your assets are tied up in non-cash inventory, and your creditors are not going to be paid in merchandise inventory. They're going to want the money. This could be a reason why you're liquidating. There's not enough cash to cover current liabilities. So step one, C, for called, convert your assets to cash. Due to the urgent need for cash, usually these are going to be sold for a loss. Think of a drastically reduced going out of business sale because you need to convert that inventory to cash as soon as possible. So step number one, convert your assets to cash. Step number two, allocate the gain or loss based on the initial P&L sharing agreement. For a ratio of 1:5:2, it would be 1 plus 5 plus 2. So that means Preston gets 1/8, seller's 5/8, and teller 2/8 of that loss. This is how you allocate it. Just as you allocated income and loss, you allocated gain and loss also. So the first journal entry converted the assets to cash, and now you need to allocate that loss based on the P&L sharing agreement. And here are your journal entries. So step one, update and post to the ledger. But your assets don't equal your liability. You took the inventory off your books, you sold it, cash came in for $125,000, but you still have a $50,000 loss that must be allocated to the partners. So step one, convert your assets to cash. Step two, allocate the gain or loss. Now you're in balance. Step three, pay your liabilities. Creditors must be paid first. Post to the ledger after you've paid your liabilities. And notice what remains. All you have is cash asset You don't have any more liabilities, so your assets equal your equity. So now your partners can take their remaining capital balances. Step 4, distribute remaining cash. You're closing your capital accounts. And don't be confused with the profit and loss sharing agreement. Your final step, you're simply closing the books. You've already allocated any gain or loss based on that agreement. Now you simply zero out the capital balances. So now you've done it. Notice all the balances are zero. You've closed your books. First step, if we're going to review, convert your assets to cash. Sold your inventory for $75,000. Now we're looking at a much smaller amount. We're going to look at a different example. So you have a loss on the sale of $100,000. Allocate the gain or loss the same way, only it's quite a bit more. First entry, convert your assets to cash and then allocate the loss to the partners. Now what remains? Notice one of the partners has a negative balance. That is known as a capital deficiency. So what happens? How do we handle this? We had to go into a negative balance on a capital account in order to have assets equal liabilities plus equity. Okay, so now what happens? In real life, Preston should absorb or pay back that loss. So to close Preston's account, Preston actually has to contribute from personal funds $600 just to zero out the account. The partner will resolve the capital deficiency. So now there's $101,300, which is divided between sellers and teller based on their balances, what is remaining. Okay, now what happens if the partner can't pay? Because more often that's going to be the case. If you're going out of business, chances are your personal finances are also in trouble. So that means someone has to absorb the loss. So the initial agreement, 1, 5, and 2, only Preston cannot pay. Treat it just like you did with the withdrawing partner. Get rid of that ratio. Now you have 5 plus 2. So of that $600 loss, the other two partners will absorb this on the books. So notice Preston's capital account is being credited to get it back to a zero balance to remove Preston from the books. Now in real life, could sellers and teller come back and take Preston to court and try to collect the $600? Yes. But the accountant, the priority here is to close your books. You can seek legal remedy later. The other partners will absorb the loss for the accounting records of the deficient partner. So now the partner Preston is gone. There are only two partners, and you're going to close the books. You're simply going to zero out those remaining capital accounts after you pay the creditors. So now the books are closed, zero balances. So the steps to remember: C, convert your assets to cash. A, allocate the gain or the loss. L, your liabilities, your creditors must be paid first. And then finally, D, then you can distribute anything that's left to the partners. And unfortunately, in some businesses, there may not be any left.